All right, welcome back to another episode of Sold As Is. I'm here with my good buddy Mike Weisberg from Lend to America. Mike, you and I had a chance to talk last week about a great new program that hit the market. And the last time one hit the market like this, it lasted like 3 hours, it felt like, yeah?
Oh, yeah. It was about a week and a half for the state to come out with the program and run out of funds.
Exactly. So I wanted you here because I want all my consumers and friends and family out there to get some information about this, and let's dive in depth about this. Tell me a little bit about what it is.
Down payment assistance.
Down payment, 100% financing.
100% financing.
Man, game changer for a lot of buyers that are out there.
Absolutely. I mean, it's one that's not going away. The money's there.
Okay.
It's an FHA first mortgage, so you get up to 96.5% financing on a first mortgage.
Okay.
The lender, we are doing another 3.5% down payment assistance for the buyer.
Wow.
And it's got all different options from no repayment on that second, or a very little payment. There's no income restrictions, low credit scores. It's got so many benefits to so many different people.
Wow.
And you're not restricted to a lot of these programs that are for only a first-time buyer, or only if you make a certain amount of income, you qualify. And all of that is gone.
So this is going to underwrite to like FHA guidelines.
Exactly.
Which
correct.
is going to be a more lenient program always that I've known FHA to be, where they allow gift money for maybe closing costs.
Correct.
And lower FICO scores.
Down to 620 credit scores.
Got you.
Debt to income ratios. Sometimes they're going over 50% for an FHA loan.
Okay. Good stuff.
Really good.
I like that. I'm going to just take a little bit of notes here so we can talk about that stuff. So on a typical FHA loan, you're putting 3.5% down. And then what you're saying is now the FHA government will subsidize the 3.5 or an assistance program?
Right. Actually, it's not even the government. It's private. The lenders are actually doing it now.
Wow.
So it's out of the hands of the government, and the last one was the state of California, where they ran out of funds. This is not tied to any of that, no restrictions on that.
So just something that popped in my head right now made me think is that means banks are pretty bullish on our real estate market.
Absolutely. They believe that this market is going up, not down.
Right.
Home values will be as good or better.
Yeah, and we're kind of seeing that. Even though interest rates have pretty much doubled, consumers have absorbed that and are still pressing on to buy, with inventory still being low. So this gives somebody a great opportunity with that may make the money income wise, but they haven't saved up a down payment, or they're transitioning into saving money. Right. They can actually become homeowners right now.
We've been seeing a lot of people that make a lot of money, but don't have a lot of savings. There's potentially people that graduated college and may have student debts and student payments, and a lot of money is going out for that, for rent, for their car and auto expenses.
Gotcha.
And they don't have a lot of savings. They can afford the payment, they just don't have the money for the down payment. So this works around that.
Gotcha. Makes sense. What about loan limits? Is it like, can I go buy a $4 million house with something like this?
So it still is up to the maximum.
Because that's like a condo here in Studio City.
Exactly. Well, it'll get you hopefully more than a condo. We're going up to the conforming loan limits, $726,200 in LA County. So that gets you quite a bit of a loan amount, $726,200 loan amount.
Got you.
On the first.
So that means that could equal 96.5% of the purchase price.
Right. So it's getting you about a $750,000 purchase price.
Wow, good to know.
Yeah.
And we talked about FICO scores. You said FICO scores were what?
Down to 620.
620, which is pretty aggressive, yeah?
Very aggressive.
And let's share with everybody the difference between that and conforming FICO scores. Like, what is on somebody on an A paper loan? What are they looking for?
Usually on a conventional conforming, you're at about a 680 credit score. That they're looking much higher.
Okay.
So FHA was always designed as almost like a first-time home buyer program with lower credit scores, higher debt to income ratios. It was more of a flexibility to get people into a home.
Got you.
But a lot of those layers have been removed with You don't need to be a first-time home buyer, which generally means you can't have purchased or owned a home in the last 3 years.
Gotcha.
This program, no restrictions like that.
Wow. What about, I know FHA has always been good for having a non-occupant co-borrower.
Yep.
Can you still do something like that?
Absolutely. So you can use the blended income from another person on the loan to help qualify. So if it's a relative, an aunt, an uncle, a sibling, all of those are fine.
Wow, that's great. Let's talk about some more pros. What else would you say is a big pro of this? I mean, we're talking about assisted programs. FICO scores are low. Loan limits are great at 720. Right. That's really good. And non-occupant co-borrowers, gift money as well. What else? What else would you say is a positive about this?
So, I mean, another big one that could potentially happen is you can get seller credit towards closing costs.
Wow.
So, in theory, you could buy a house with 0 down payment and 0 closing costs if the seller negotiated with the buyer to pay their closing costs. So you could get into a home right now with 0.
Wow. So, I mean, there's got to be a catch. Tell me, the interest rates are 10%.
No, the rates are about 0.75% to 1% higher than a standard FHA. So if rates right now in an FHA were at about 6.75, the rate might be 7.75 as an approximate.
You and I talked a little bit about a couple of options because a repayment of this assistance, the 3.5% down. There's a couple options. Share with me a little bit about that.
Yeah, there's 2 options that you can do on the second, on the down payment assistance. There's a no payment on the second. So 0 payment, 0 interest. It's a 10-year term that you have to stay in the property, not refinance or sell. And at the end of the 10 years, that loan is forgiven. Gone.
Wow.
Oh, nothing. The second option is you make a payment on it. It's amortized over 10 years, but only on that second mortgage. So, or the down payment assistance, let's call it.
Gotcha.
So that down payment assistance at amortized over 10 years at, let's say, a 2% above the start rate on the first. Okay. So now that's, let's say, 9.75 on a $20,000 loan. That might be like $230 a month, $250 a month of a repayment. But then there's no time limit that you have to keep that loan. So in 6 months, if you wanted to refinance or sell the property, you could, and that second is gone.
Hey, Tom here. Real quick, if any of the information you're hearing on today's podcast resonates with you, make sure to reach out to us. All right, let's get back to that episode. Wow. So on the first option then, where there's no interest, but you have to hold it for 10 years, if I were to refinance earlier than 10 years or sell the house in 10 years, then there's a prepayment penalty or a recapture of that money?
It's a recapture of that entire amount, correct.
Okay.
Of that 3.5%.
And what are you finding most of your clients right now taking? Are they doing option 1 or option 2?
They're doing option 2, the repayment, because then they're not tied into staying there for 10 years without refinancing or selling. The payment, because it's such a small amount in theory compared to the first, let's say it's a $700,000 first,
right?
But it's only a $20,000 second, that payment is very minimal.
Gotcha.
In theory, it's a couple $100 a month. And then you have that flexibility that should rates drop, let's say next year, rates drop to 5%, you could refinance and that's gone.
Gotcha.
You don't have it. So you could refinance. Maybe you go from an FHA to a conventional loan.
Right.
Maybe you bought a house that needed some work and you got a good deal on it and you did this FHA first and the down payment assistance, and then you did the work into the property to improve the condition. And now that property has gone up $50,000 in value next year.
Right.
So maybe we're going to do a refinance out of that FHA into a conventional loan and just have one new loan at that point.
And you know, that's kind of makes me think about a lot of times what I'm talking to a lot of my clients about is looking for properties that have these value add options or opportunities for them, because to go and buy a property right now, July of 2023, and buy one that's already spec'd and brand new, there's nowhere to go with that house.
Right.
If the market shifts down, it's not like I can add a bedroom or add a bathroom or update a kitchen because it's already been done.
Correct.
So a lot of my clients, we've been looking at properties that do need some distress or have some, need some TLC so that there's some value add to that. So this actually would complement that thought process of home buying because you could do an improvement, create some equity, and then get off of this loan.
Absolutely. Let's say it's like everybody's
So
doing
it's a
these,
teaser loan almost. I mean, it's a loan to get you in.
Absolutely, to get you in, and it keeps the money in your pocket to do the improvements in the property.
Nice.
So maybe it's for whatever that, it's an addition, it's an accessory dwelling unit.
Right.
It's adding another bathroom or doing an upgrade or a remodel. You've just kept all that money in your pocket for the down payment and maybe the closing cost. That's a significant amount of money you've got to add to the property, appreciation.
Now, does that second, if you do option 2, does that second payment get added? That $200 obviously gets added to your qualifying.
Correct.
So there could be an issue with somebody who that might take them out of that 50% debt to income ratio where they might have to go option 1 because they're already pushing the boundary, and it is what it is.
But the other part to it is that you could then also be paying a little bit higher rate on the first for the first option with no repayment. Could bring your rate up a little bit higher on that first option too.
Oh, so they'll actually give you a bump down if you take option 2.
Correct.
Got you. Last time you and I talked, when these markets started shifting up and down, everybody were doing the 2-1 buy downs.
Yep.
Could this be done with that, something like that?
You could do a 2-1 buy down, but remember, there's a cost to that.
Yeah.
So you're paying a fee, whatever that may be. For a 2-1 buy down may cost, let's say, a point or a 1.5%, 1% of the loan amount. So if you're trying to reduce how much to get into a property and keeping the cost down, that could actually raise your costs up.
Gotcha.
But the benefit would be is you would have a lower monthly payment,
right,
and a lower qualifying rate.
Gotcha.
You could qualify for potentially more.
So it could be a good idea. It's not necessarily
Absolutely.
a bad idea, especially if you could leverage some of that buy down from seller credit.
Correct.
Gotcha.
And you can get up to 6% seller credit on FHA loans. So if you had up to 6% in closing costs, you never are going to have 6% closing costs unless you started doing buy downs and other things to add those numbers up. But then that is something you can negotiate with the seller.
Gotcha. FHA, I know kind of one of the things for me as I think about it is like with condos, not all these properties are FHA approved.
Right.
So not necessarily a big player for somebody looking to buy a townhome or condo?
Well, 2 years ago, I would have told you FHA for condos, forget about it, because a lot of the properties just didn't do the renewal process to stay FHA approved.
Right.
Now we've gotten back into what we call a spot approval, FHA spot approval.
Okay.
So we're actually getting the individual condos, not the entire project, but that one door approved.
Gotcha.
And we're doing that within 30 days.
Oh, wow.
So that process has gotten a lot easier again.
Okay.
To actually do FHA financing on a condo.
Gotcha. Are there like an additional cost or anything like that that the consumer has to pay for?
No.
So really?
It's just gathering documents. It's an appraisal that we're going to need anyway.
Okay.
It's gathering HOA documents.
Okay.
And paperwork and submitting it to FHA to review.
Because I remember years ago when spot approval started, it was like, oh no, it's going to take 90 days and it's like another fee and this and that. And the buyer would be like, well, I'll pay for it.
Right.
But it was like, no, I've got 4 other buyers that didn't have to worry about that.
Right.
They streamlined that process.
That process is streamlined. It used to be up to a couple $1,000s to get that approval. Now that's gone. The banks are doing it directly with FHA. It's an expedited process.
There could be some value to the consumer with that as well. I mean, if I've got one unit in the building out of, let's say, 18 or 20, and I'm the only one that's FHA certified or on the approved list, that might be more of an attraction to the consumer when I go to resell it.
Correct.
Right?
And most of the time FHA loans are assumable. So that could potentially be something down the road if this loan that the person gets is at a good rate and terms, they might just want to take over that loan.
Gotcha.
When they're buying the place or when they sell it down the road.
This kind of, I remember last year when the rates jumped up, it was date the rate and marry the house was the conversation, because but this loan does fall into that idea, because I think that's what right now a lot of consumers, Mike, are why they're in the market, because they know that these rates, they have to come down, and I'll take 7.5 or maybe 24, 36 months, but they will come down and I'll be able to get onto a lower rate. So this loan actually gives the consumer a chance to put no money down. Yeah, you're taking a bump in rate, but when the market rates shift downwards, you can take advantage of that.
For sure. This is from all the different economists and everybody I've been hearing, it's been 100% consensus that next year they expect rates to go lower.
Yeah.
Now, to what level, we don't really know, but it's an election year. There's all these motivating factors to keep rates low. But on the other side, everybody's estimating home prices to be at or above this level, to appreciate, not to decrease at all.
Gotcha.
So that's where these programs have a high confidence of what's going on in the real estate market, especially in the Los Angeles marketplace, that home values are going to stay strong. Otherwise, they wouldn't give a program that you can get 100% finance.
I hope that you are enjoying this episode of Sold As Is. And if you'd like some more information, please feel free to reach out to us. Make sure you hit the like and subscribe button down below so that you can be notified of any future episodes. All right, let's get back to the show. So what about underwriting guidelines? I mean, I remember with conventional, there used to be this, I got a DU approval and it came out in seconds, and FHA, I don't know, was always kind of known for something like that. Mike, tell me it's evolved.
It has. So the good news is it is like the exact same process of a conventional loan.
Okay.
We get the automated underwriting approval. That takes minutes. Okay. So you plug in the borrower's income, you run their credit. It analyzes several different things, the property, approximate values that other homes have sold for in that area. And within minutes, it's analyzed this and it says, based on all those factors, this loan's approved and this is what we need. It may say you only need a pay stub or you need their last year's W-2. Awesome. Maybe it needs tax returns, maybe it doesn't.
Okay.
It'll list all that stuff. Now, you got to remember, an automated underwriting approval is only as good as the data that you put in.
I agree.
So you can trick a system and say, hey, somebody makes $1 million a year when they only make $50,000 a year.
Right.
So bad data in, bad data out. But this is the first step, and all loans today are pretty much getting validated by an automated underwriting system.
Gotcha.
So FHA is no different. It runs it through, looks at the basic info, and then it actually goes to a human being, an underwriter, that will
the good old days.
Yeah, they're going to look at the pay stubs. And if you said they make $10,000 a month, they're going to look at the pay stub and say, do they really make that money?
Yeah.
Do they have this money in the bank? So they're going to validate that for a formal loan approval. Gotcha. But the turn times are the same. I mean, generally, they're 24 to 48 hours in underwriting for a full underwriting approval.
Good. You just made me think now, appraisals. Mm-hmm. Typically I would like to see a conventional deal because a conventional appraiser went out there and flicked a couple switches and said, okay, it's a value. And an FHA guy in there went and turned on your burners on your stove and stuff like that. And it's like, a burner's out. And you're like, but how does that affect the value of the house? Right. Obviously I'm exaggerating about a burner, but it felt like that when they would come back and give me this laundry list of things that needed to get done in order to meet the FHA requirements.
Right.
Same problem there?
I don't want to put it as a problem. There are definitely some additional things that an FHA appraiser looks at that a conventional appraisal wouldn't. So let's give you for instance, a real life one that happens. Peeling paint.
Yes.
So we think, peeling paint, it's peeling paint. Well, FHA, their concern is lead-based paints from 40 years ago, 50 years ago, and that the peeling paint could flake off, and maybe a child could pick up a piece of peeling paint and ingest it. and that's lead-based paint poisoning.
Yeah.
So those are things that they try to protect. So if there's peeling paint, an appraiser is going to call that out.
Gotcha.
And say, hey, this needs to be fixed, which, they scrape it, they prime it and paint it, and it's fixed.
Gotcha.
Versus a conventional appraiser, they don't get into that stuff. Heating is a requirement. Now, we go in California, heating?
Yeah.
You would think more like air conditioning is a requirement, but you don't need to have air conditioning as a requirement.
Yeah.
You have to have heat because they don't want somebody to freeze to death.
Yeah.
That's the theory. But we don't get those extreme colds here in California like you get in the Northeast.
Right.
So those are certain things that an FHA appraiser is going to look for, the heat source.
Yep.
Certain things. They are going to look at a few of those safety issues a little bit more in depth than a conventional appraiser.
The gas shutoff valve.
Yep.
I mean, they all look at water heater straps and stuff
Correct.
like that, and the smoke and carbons and stuff like that. But
Yep.
they do a little bit more in depth, and I guess for the consumer, it's probably for their benefit.
For sure.
I
mean, like you could close on a house that didn't have carpet.
Yeah.
Some people go, oh, wait a minute, the carpet is worn and it's need to be replaced. Well, carpeting, you don't have to have carpet as long as you have wood down, even if it's plywood on the floor. That's flooring.
Good to know.
In theory, that's flooring. Now, you may not want to be walking around. Obviously, if there's nails sticking up out of the flooring, that's going to be an issue. But those are certain things. But it's evolved where it used to be nobody, back in the day, 15 years ago, nobody wanted to touch an FHA deal because they thought that the appraisal part was going to be a monumental task. And it really hasn't these days. It's real minimal these days.
Good. I mean, especially when we're looking at properties, like we said earlier, about some upside potential, you want to make sure that the FHA appraisal doesn't throw a wrench in it by calling out some repairs that you planned on doing after you moved in, and now you're negotiating with the seller to get them done prior to, so stuff like that. Let's jump into, I would put that in my con category, potential cons category, but let's talk about little cons, because we got a lot of pros here. Let's tell the audience a couple of cons. Mike, tell us what do you got?
So
there's got to be an education class or some type of.
There's definitely there's a home buyer education class.
I knew it.
But it's online.
Okay.
It's probably a $50 cost to do an online, an hour or two home buyer education. Now we call it a con because it's like you got to do a step. The reality is it's an educational class.
Yeah.
So somebody that hasn't owned a home before and they go through this.
Yeah.
It goes through a lot of things of what to expect as a homeowner.
Yeah.
The things that you may not be thinking about, the landscaping, the gardening, the water bills, and, transferring utilities into your names. Things that maybe if you're renting, somebody else took care of those things for you. But now as a homeowner, you're on your own doing this. So I think it's really good because it talks about certain budgeting of money and expenses, so that you can afford it. The last thing we want to see people doing is losing their home because of financial mismanagement.
Right.
And so this really does help us. So
I love that.
I hesitate to call it a con because, it's a step. It's another step you've got to do. Another thing that some people may look at a drawback is mortgage insurance.
Good old mortgage insurance.
So mortgage insurance, people go, oh, it's insurance, it protects me. No. Mortgage insurance protects the lender.
Yeah.
If somebody stops making their payments, the mortgage insurance company will pay the lender a fee while they go through the foreclosure process against the homeowner for not making the payments. So it's only helping the lender, not you. It doesn't be like, hey, I can't make my payments. I've got mortgage insurance. It's going to step in and make my payments for me. That's not how it works. It's only a safeguard there. And it's an FHA requirement that it is there for the life of the loan. It used to be once you got to a certain percent loan to value, like an 80% loan to value, that it would drop off. FHA changed that a couple years ago. It's there for the life of the loan.
Right.
So until you sell or refinance out of that FHA loan, you've got that mortgage insurance. Now, the good news is it used to be at a percent, like 0.85% of the loan amount is the calculated amount.
Right.
That's dropped down to as low as we've seen now, 0.5%.
Wow.
So it's lower than it used to be.
Right. I was just going to bring that up too. I think FHA loans, or the FHA administration, took some really good steps this year to lower the percentage of how they calculate that monthly fee to make it more affordable for the consumer, where conventional loans haven't done that yet. Am I correct?
Correct.
So if you're going to have to pay mortgage insurance, FHA is probably the one to do it for.
It's a lower amount.
Yeah. Now, there's no paid mortgage insurance like conventionals. Conventional, you can add a fee to the rate and they'll absorb it.
Correct.
But on FHA, they don't do anything like that.
Right. So that's called lender-paid mortgage insurance versus borrower-paid. So lender-paid mortgage insurance is only on a conventional loan.
Okay.
Now, also, you got to remember, in addition to this monthly mortgage insurance, there's an upfront mortgage insurance premium.
That. The MIP.
Okay? MIP, which is 1.75% of the loan amount. So whatever that loan amount is, 1.75% of that loan amount is going to get added for mortgage insurance premium to the final loan amount. So you have an option. You could either, let's just say 1.75, percent on $100,000 is $1,750.
Right.
So your $100,000 loan goes to $100,175.
Right.
You could pay that out of pocket up front, so you keep your loan amount lower. Almost always, I would say 99.9% of the time, people just add it to the loan.
Sure.
So you don't have to come out of pocket, but they're adding that premium. It's an FHA, a government premium that they're adding to do this loan.
Right. So two things on that is, one, in real estate, they teach you leverage, meaning put as little money as yours down and leverage it, i.e. the bank's money. So that's why everybody would do that. And two, that means you're actually borrowing 101.75% of the value, right? But that tells you that the bank is willing to take a risk in today's market and loan you 101.75% of the balance. And these are the biggest, smartest institutional brains out there, right?
Correct.
I mean, when you look at a lot of these analysts that are out there at these banks, you guys, these are the smarties of the smarties, right? That are looking at these and saying, hey, we're willing to take this calculated risk in real estate in July of 2023 and lend somebody 101.75% of the value of the home, because we know this housing market's going to be strong.
Yeah, I think there's a couple factors to it. They definitely are believing in the market that, with the housing numbers and the shortage of housing supply, with the people, the Gen X, the Gen Zs, all these people moving into this phase of home buying, and the shortage is only going to keep home prices high.
Right.
The other part is that they have a high confidence in the people that they're lending the money to, because they're looking at their credit, they're looking at their income, and they're seeing that this is a good credit-worthy person to lend this money to. So they feel like there's a lesser chance of a default.
Yeah.
I mean, when you start analyzing what a mortgage payment is, after your tax deductions and your expenses and everything, what you're truly paying per month on that mortgage versus what you'd be paying in rent today, with where rents have gone, I mean, it's pretty much a wash. But the upside is you've got home appreciation on your side. You've got tax benefits.
Yeah,
and
tax shelter.
And when we kind of start looking at the pros and the cons, I mean, the list is greatly outweighed of what the negative is. Obviously, somebody that had money to put down, 20% down,
sure,
they're going to have a lower monthly payment because they're not going to have mortgage insurance and all these other little things. But for somebody that doesn't own right now and doesn't have that savings, this gets them into the market to buy now.
Gotcha. Well, good. Anything else that you saw in your notes there, Mike, you want to share with anybody?
That income piece is so critical, to not have a cap on the income. A lot of these programs that people hear about, these down payment assistance programs, are tied to area median income limits.
Yeah.
It might be low or moderate income numbers.
Right.
And when you start adding those numbers in, you're probably looking at a $400,000 purchase price.
Right.
In LA County based on this. Because if you've got a car payment and some credit card debt and all those things, you're getting greatly reduced into what you can get.
Yeah.
I mean, I hear people that are like, oh, we're giving out down payment assistance. And then the next thing they say is, well, yeah, we give up to 2% down payment assistance, maximum $4,000. I'm like, well, wait a minute. So you're basically giving, that's basically a $200,000 purchase price of a house. You're giving 2%. That's $4,000. Where are you going to get a $200,000 house in LA?
Right.
That may be something in the Midwest that's an option.
Right.
But this specific program is really a California, LA-based program.
I remember a lot of these other programs used to be redlined in areas. The police, the officer next door program, or the teacher next door program, they would redline you until you could only buy in certain geographic areas that they were trying to either gentrify or change the dynamics of those areas. So this doesn't play into that either. No. This is, hey, if there's a place in Studio City that meets it, you're in there, and you're not necessarily redlined. So that's some really
single family
stuff.
Residence, 1 to 2 units, no 3 or 4 units.
Okay.
And no geography restrictions.
Got you. Now, into those units, can one of them be a rental and use that rental income?
They're not going to give you rental income on that second unit.
Okay.
Because it's always as a primary residence is how they're looking at this program for FHA.
Okay.
Is for primary residence.
Okay.
But you could buy a 2 unit where maybe you're buying with a parent or a relative, and they're going to occupy the other unit.
Gotcha.
And you're going to occupy one. Completely fine.
Good. Well, I've got a page here of some really great notes, Mike. Anything else that you saw that you brought from your charts there that you wanted to share with anybody? We touched on it.
I would say apply now. The process is so quick and easy.
I love it. Well, Mike, we're going to put a link at the bottom of this video to your website with your phone numbers, all your contact information. So if you guys want to reach out to Mike Weisberg from Lend to America, broker owner of his own company. So I think that's important to know. You've done my loan, you've done my son's loan, you do all my family's business. So somebody that he's I trust with my mortgage as well. Let's do just a real quick recap here. So it's an FHA 3.5% down with an assistance program. Mm-hmm. There's a couple of options that the consumer can choose. Option 1, they can have forgiven if they stay in the property for 10 years. Right. But if they sell or refi before that, they will have to pay a recapture fee. Or they can choose option 2, which you said is the big plus, in that they will they'll take the balance, or that 3.5% on a 10-year amortized loan,
exactly,
at about a 2% bump over today's rate. So figure they're going to carry that at 9%, but there's no prepayment penalty there, and that's where most of the consumers are going.
Yep.
Buy down could be a good idea for this if we could get the seller to pay some of your closing costs for you. Gift money still good. All the FHA parameters of lower FICO scores, less time I'm sure on the job, and gift money and all that stuff still works. Spot approvals for condos are still there, and they've modernized the underwriting program for FHA, so it really is very competitive to conventional.
Correct.
There is that home buyer education seminar that they have to take online, but it's really a value for a lot of them because they get to understand what to expect in home ownership, so I think that was really good. Underwriting, the mortgage insurance premiums there, just like before, and the upfront MIP along with mortgage insurance are both there, part of the FHA program as well. The condition of the property could be an issue in understanding that some health and safety issues with lead paint and things like that could be a concern. So make sure that the realtor of choice goes through the property a little bit better to make sure if there's anything like that, so you could address it ahead of time in an offer. I really like the note here of the banks have a lot of confidence in the consumer. that's you. To believe that it's not just the market driving it, but people's jobs and ability to repay these mortgages. They have a lot of confidence in that. Renting versus owning. He said that when they analyzed the data, that really this is a value to get people to own versus renting. No cap on income. I think that's a big one there as well. And 1 to 2 units.
There's really no bait and switch. This is a legitimate program to get these people into a home this year.
I love it. So listen, if you're out there and any of this information resonates with you, please feel free to reach out to us, Mike or Tom. We'll have some links down for both of us as well. And also make sure you like and subscribe to our YouTube channel here, so that way you can be notified of any future events. Mike, I think we're going to sign off here. Any closing thoughts?
I'm happy to see this market where we're at with these new opportunities for first-time buyers or move-up buyers. This is just a win-win all around.
All right, well, that wraps up another episode of Sold As Is, and we'll see you on the next one.